Investing looks exciting, but one wrong move can cost you years of progress. Most beginners think they're doing everything right until the truth hits hard. The stock market, crypto, and even real estate are full of hidden traps. And the sad reality is, beginners fall into the same mistakes over and over. These lessons could save you thousands, even hundreds of thousands. So grab a notebook, because every detail here matters. The smartest investors aren't the ones who risk more. They're the ones who avoid losses. Let's uncover the top 5 investing mistakes beginners must avoid. 1. Chasing quick profits without a plan. The first and most common mistake beginners make is chasing quick profits without having a real plan in place. They see a stock or crypto coin skyrocketing and immediately feel the urge to jump in, driven by greed and fear of missing out. At first, it feels thrilling. You see green numbers and think you've made the right choice. But without a plan, emotions take over, and emotions are the enemy of smart investing. A beginner who buys blindly usually has no strategy for when to sell, how much to risk, or what role that investment plays in their overall portfolio. When the market turns, they panic and sell at a loss, often right before the asset recovers. This isn't investing, it's gambling, and gambling always favors the house. Real investors don't rely on luck, they rely on rules and strategies. They set clear entry points, define their exit plans, and calculate how much they can afford to lose. Without this discipline, beginners become victims of their own emotions. To avoid this trap, you must shift your mindset from chasing hype to building a structured, long-term strategy. If you don't plan, you're planning to fail, and the market will teach you that lesson the hard way. 2. Ignoring diversification. The second deadly mistake is putting all your money into one single asset or sector. Beginners often think, this stock will make me rich, or crypto is the future, so I'll go all in. When that asset performs well, the confidence feels intoxicating. You start to believe you've cracked the code. But what happens when it crashes? In one moment, years of savings can vanish, leaving you with nothing but regret. That's why diversification is the foundation of smart investing. By spreading your money across multiple industries, asset classes, and even countries, you protect yourself from devastating losses. Think of it like insurance, boring but life-saving when disaster strikes. Even legendary companies like Enron, Lehman Brothers, or FTX collapsed overnight, wiping out investors who believed they were too big to fail. Diversification ensures that one bad bet won't sink your entire ship. Yet beginners ignore this lesson, often seduced by the idea of massive returns from one magical investment. The truth is, wealth isn't built on one home run, it's built on many steady hits. Spread your risk, balance your portfolio, and you'll still grow consistently while sleeping peacefully at night. Remember, never put all your eggs in one basket, because markets love to flip baskets when you least expect it. 3. Timing the market instead of staying consistent. Another classic mistake beginners make is believing they can outsmart the market by predicting highs and lows. They wait for the perfect moment to buy, or they panic sell the second they see red numbers on the screen. It feels logical at the time. Nobody wants to buy at the top or hold through a crash. But history proves time and time again that timing the market is nearly impossible, even for experts. In fact, studies show that missing just a handful of the best performing days in the market can slash your long-term returns in half. The truth is, markets move in cycles that no one can predict consistently. The winning strategy isn't timing, it's consistency. By investing regularly, regardless of market conditions, you protect yourself from volatility through dollar-cost averaging. You'll buy at highs, you'll buy at lows, but over time, you'll build a strong average that compounds steadily. Beginners often waste years sitting on the sidelines, waiting for the right moment that never comes. Meanwhile, disciplined investors who stick to their plan quietly build wealth year after year. The market rewards patience, not prediction. If you stay consistent, time becomes your ally, and compounding turns small contributions into life-changing fortunes. 4. Letting emotions control decisions. Perhaps the most dangerous mistake of all is letting emotions dictate your investment choices. Fear and greed are powerful forces, and beginners often fall victim to both. They panic during market dips, selling investments at a loss out of fear, only to watch prices recover right after they exit. Then they get greedy during rallies, buying into hype at the peak, only to watch their investment collapse. This cycle of buying high and selling low destroys portfolios and confidence alike. The truth is, markets are designed to test your emotions. Headlines scream panic during every downturn, and hype builds during every boom. If you allow emotions to guide you, you'll always be on the losing side of the trade. Smart investors rely on discipline, not feelings. They follow a plan and stick to it regardless of what the market looks like on a given day. They understand that crashes are temporary, but mistakes fueled by panic can be permanent. To succeed, you must train yourself to see through the noise and trust your strategy. The greatest skill in investing isn't finding the next big winner. It's controlling your emotions when everything around you feels uncertain. 5. Ignoring the power of education. The final mistake, and perhaps the costliest, is failing to invest in yourself before investing in the market. Too many beginners rush in without learning the basics of how markets work. They throw money at stocks, crypto, or real estate based on hype, social media posts, or influencer advice. It feels easy until reality hits and they realize they don't understand what they've bought. Without education, investing is nothing more than gambling with your hard-earned money. And unlike gambling, the market doesn't care about luck. It punishes ignorance harshly. The most successful investors dedicate time to studying. They read financial reports, learn about economic cycles, and understand the fundamentals behind every investment they make. They never stop learning because the market never stops changing. Education is the real shortcut to success. Every book you read, every course you take, every mentor you learn from gives you an advantage that beginners without knowledge will never have. Ignoring this step guarantees costly mistakes, but embracing it sets you apart as a serious investor. Knowledge turns risks into opportunities and mistakes into lessons. If you skip this, you're doomed to repeat the failures of others. If you embrace it, the market becomes your greatest teacher. So there you have it, the 5 biggest investing mistakes beginners must avoid. Each one looks simple, but combined, they can destroy your financial future. Now you know how to protect yourself from the traps that catch millions. Remember, investing is not about luck. It's about discipline and patience. Build a plan, diversify, stay consistent, control your emotions, and keep learning. That's how small investors grow into wealthy investors over time. Don't let these mistakes steal your future. If this video gave you clarity, hit like right now. Subscribe for more financial strategies that schools and banks never teach you. And share this with someone just starting out. They'll thank you later. The smartest investors are those who avoid mistakes, not just chase wins. Now it's your turn to step into the market with confidence.